Two people start with the exact same $50,000. 20 years later, one ends up stressed managing tenants and repairs. The other builds the same wealth, doing almost nothing. And when you see the real numbers, it flips everything. Ryan uses it as a down payment on a $250,000 rental property, 3 bedrooms in a decent neighborhood, mortgage at 7% monthly, payment around $1,330. He finds a tenant paying $1,800 a month. On paper, that is $470 a month in profit before he spends a single dollar on anything else. In reality, that number is a lie. Alex puts the same $50,000 into a total market index fund, sets up $300 automatic monthly contributions, and does not think about it again. His coworkers ask what he is investing in. He says index funds. They nod politely and change the subject. Nobody is impressed. Day 1, Ryan has a house, a tenant, and a story to tell. Alex has a confirmation email. It is not close in terms of how it feels, but feelings and math are two very different things. For the first few years, Ryan is living the landlord dream. Rent hits his account every month. He drives past the property and thinks, I own that. He is building equity. Everything feels real and smart. Alex logs in once a quarter, sees the number, moves slightly and closes the app. This is where everything starts to break. Now here is what the spreadsheet actually says. After 3 years, Ryan collected around $64,800 in rent. Mortgage payments totaled $47,880. That leaves $16,920 in gross cash flow. Sounds great. Until you subtract everything else. Property taxes, $3,000 a year. Insurance, $1,500. Water heater replacement, $1,200. Roof repair, $2,800. 1 month. Vacancy between tenants cost $1,800 in lost rent, plus $600 to clean and relist. Ryan manages it himself to save money, which means calls at 10 p.m. and weekends coordinating repairs. After all real costs, Ryan's actual net cash flow over 3 years is somewhere between $2,000 and $4,000, not the $16,920 that looked so good on paper. And that does not include a single hour of his time. Alex, meanwhile, has contributed $50,000 plus $10,800 in monthly contributions at roughly 10% average annual return. His portfolio is sitting at about $76,000. He spent 0 hours managing it, 0 phone calls, 0 emergencies. By year 10, Ryan's property is worth around $335,000. His remaining mortgage balance is about $166,000. Equity, approximately $170,000. Real number after all costs, including mortgage interest, taxes, insurance, repairs, and vacancy. Solid but expensive in time stress and risk concentration. Alex's portfolio with consistent contributions and 10% average returns is sitting at approximately $165,000 to $180,000. He put in $86,000 total. The rest is pure compound growth. He spent exactly 0 weekends fixing anything. At year 10, they are surprisingly close in total wealth. Ryan might be slightly ahead thanks to leverage, but Ryan also spent hundreds of hours managing his property, took on hundreds of thousands in debt, and concentrated everything in a single asset, in a single zip code. Alex diversified across thousands of companies and never lost a night of sleep. By year 20, Ryan's property is worth around $450,000 to $500,000. Equity, somewhere between $400,000 and $500,000. After 20 years of maintenance, repairs, turnover, taxes, and at least 1 major renovation, his total net cash flow, above expenses, might be $40,000 to $80,000. Alex's portfolio at 10% average annual return with $300 monthly contributions has grown to approximately $420,000 to $460,000. Total. Contributions of $122,000 over 20 years. Other $300,000 is pure compounding, no debt. No tenants. No 2 a.m. calls about a broken pipe. Same destination. Completely different journey. Ryan worked for his wealth. Alex waited for his. Ryan had leverage, stress, and illiquidity. Alex had volatility but freedom and liquidity. Neither path is wrong. Real estate wins when the rent-to-price ratio is strong, when you treat it as a business, not a side hustle, and when you use strategies like house hacking to reduce your own housing costs to near zero. Index funds win when you increase contributions consistently, when you never panic sell, and when you value your time as part of the return calculation. Most people do not lose money because they chose stocks or real estate. They lose because they never actually ran the numbers, and by the time they realize it, they are already years into the wrong path. If you want breakdowns that actually show what is real, subscribe, because guessing with money can cost you years.